What actually happens if you put $1,000, $10,000, or $100,000 into MSTY today? Here's exactly what could happen to your money, year by year and decade by decade. No fluff, no hype, just the real math, the income, and the one trade-off that decides whether this is a tool or a trap. So you can see exactly how your money plays out. Now here's the emotional side of it. For someone starting with just $1,000, it might be a fun experiment, a chance to turn pocket money into something bigger. But at $100,000, that's real life-changing money on the line. It's the difference between buying a house, retiring early, or watching years of savings shrink if things go wrong. And that's why this video matters. Because MSTY isn't like your standard dividend ETF. It's a financial machine, one that's spitting out jaw-dropping payouts right now, but with a catch buried deep in its design. Some investors call it a passive income powerhouse. Others call it a slow leak disguised as a fountain. In the next few minutes, I'll show you, step by step. First, I'll break down what MSTY actually is in plain English so it finally clicks. Then, we'll run side-by-side projections for $1,000, $10,000, and $100,000 over 1 year, 10 years, 20 years, even 30 years. You'll see not just growth, but exactly how much in monthly and yearly dividends those investments could throw off. And at the very end, I'll reveal the one trade-off every MSTY investor has to face and compare it to a boring index fund alternative that might actually surprise you. Because here's the truth. Sometimes it's not about how much you start with, but about knowing the game you're really playing. And with MSTY, the game is unlike almost anything else in the investing world. So what exactly is MSTY, and why are people talking about it like it's some kind of money printer? On the surface, MSTY looks like an ETF that just spits out massive monthly payouts. But under the hood, it's not your typical dividend fund. It doesn't own companies that send you cash like Coca-Cola or Apple. Instead, it's built around one single stock, MicroStrategy, better known by its ticker symbol MSTR. And here's where things get interesting. MSTY doesn't actually go out and buy MicroStrategy shares. Instead, it builds what's called a synthetic long position, which is just a fancy way of saying it uses options to pretend it owns the stock without actually owning it. Think of it like leasing a car instead of buying it. You don't technically own the car, but you get to use it almost the same way. MSTY is doing the same thing with MicroStrategy stock. Now here's the real kicker. On top of that synthetic position, MSTY sells call options. In plain English, it's like renting out your car every weekend. You still get to use it most of the time, but you pocket extra cash when someone else wants a ride. That extra cash is the premium MSTY collects, and that's what fuels those jaw-dropping monthly payouts. This setup works best when MicroStrategy's stock moves sideways or only creeps up slowly. In that environment, MSTY just keeps pocketing option premiums over and over again. But if MSTR suddenly skyrockets, MSTY has to give up the upside above a certain point. The growth gets capped. All right, now that you understand how MSTY works, let's get into the part you actually clicked for. What happens if you invest $1,000, $10,000, or $100,000 into this fund? To keep things realistic, I'm not going to assume MSTY keeps paying 120% forever. That's unsustainable. Instead, we'll use a more grounded number, around 15% annualized return with dividends reinvested. That reflects strong income potential, but also the fact that payouts shrink over time as volatility cools off. Let's break it down starting small. Scenario 1, investing $1,000 in MSTY. After 1 year, your $1,000 would grow to about $1,150. Not life-changing yet, but you'd also pocket around $150 in dividends. That's like buying yourself a brand new pair of sneakers every year, funded just by your money working in the background. After 10 years, if you keep reinvesting, that $1,000 snowballs to about $4,000. More importantly, the yearly dividends now add up to around $600 a year or $50 every month. Imagine your Netflix subscription being permanently covered just from this one small investment. After 20 years, now the magic of compounding starts to show. That $1,000 turns into roughly $16,000. At this stage, your dividends could be paying out around $2,100 per year, or about $175 every month. That's like your utility bill covered from just $1,000 you set aside 2 decades ago. After 30 years, if the strategy keeps delivering, your $1,000 would be worth around $66,000. And the yearly dividends, nearly $8,600 a year, or about $716 a month. That's enough to cover rent in many cities, all from a tiny seed you planted decades earlier. Now let's scale it up by a factor of 10. Scenario 2, investing $10,000 in MSTY. After 1 year, your $10,000 grows to about $11,500. And the dividends, roughly $1,500 in cash flow. That's a brand new iPhone paid for every single year without touching your salary. After 10 years, your $10,000 has turned into about $40,000. Yearly dividends are now around $6,000 or $500 every month. That's your car payment covered permanently. After 20 years, the snowball gets serious. $10,000 becomes $163,000, throwing off about $21,000 in dividends every year, nearly $1,800 per month. That's like having a second income stream. After 30 years, the long haul paints a wild picture. Your $10,000 has compounded to around $662,000. The dividends, about $86,000 annually, or over $7,100 every single month. That's a full-time salary generated passively. Here's where the numbers get jaw-dropping. Scenario 3, investing $100,000 in MSTY. After 1 year, your $100,000 could grow to $115,000 while paying out $15,000 in dividends in just 12 months. That's more than what many people save in a year of working. After 10 years, that initial $100,000 balloons to about $404,000, and the yearly dividends around $60,000 a year, or $5,000 every single month. That's retirement level cash flow already. After 20 years, $100,000 grows into $1.63 million. The dividends? A staggering $210,000 per year, or $17,500 monthly. That's the type of income that can buy freedom. After 30 years, now it gets almost unbelievable. Your $100,000 turns into roughly $6.62 million, and the yearly dividends, about $860,000 annually, or more than $71,000 every month. That's millionaire lifestyle money, just from an upfront investment of $100,000 and time doing the heavy lifting. Here's the point. These numbers live on paper. Real-world performance depends on volatility, management, and whether MSTY can keep up payouts over decades. That's why, later in this video, I'll compare it directly with a boring S&P 500 index fund, so you can see the trade-offs side by side. Because at the end of the day, numbers this big can feel like magic, but in investing, there's no magic, only math, risk, and time. Now, before we get carried away with those huge projection numbers, let's put MSTY side by side with something much more familiar, a boring old S&P 500 index fund. Historically, the S&P 500 has returned about 10% to 12% per year over the long run. Not flashy, but consistent. If you put $10,000 into an S&P 500 fund and left it alone for 30 years, it would grow to around $174,000. Solid growth, but nowhere near MSTY's wild $662,000 projection. Here's the trade-off. The S&P 500 doesn't pay you flashy monthly income, but it does deliver steady long-term appreciation. The companies inside it, Apple, Microsoft, Amazon are real businesses generating profits. Your dividends grow over time and your principal usually trends upward. MSTY, on the other hand, is like a high-yield machine. It spits cash at you up front, but its long-term growth is uncertain and much of the payout is actually your own money coming back to you. Let's bring this down to earth with two quick stories. Meet Sarah. She's 25, just starting her career, and after months of saving, she finally has $1,000 to invest. To her, MSTY feels like a chance to turn small money into something meaningful. If things go well, in a few decades, that $1,000 could quietly grow into a nest egg, paying her rent every single month. For Sarah, it's not about getting rich today. It's about building confidence and seeing what her money can do. Now meet David. He's 40 with $100,000 saved up. For him, this isn't play money. It's the foundation of his financial security. If MSTY performs, it could generate income bigger than his paycheck. But if it slips, the losses would sting for years. For David, the stakes are real and the margin for error is thin. These two investors show the same truth. With MSTY, the numbers look incredible, but what you risk depends entirely on how much you put in. Now, would I use MSTY as my portfolio's backbone? Probably not, but would I consider it as a targeted income tool, used carefully and monitored? Yes, if I were comfortable with the mechanics and tax consequences. Now, MSTY isn't the only yield max ETF pulling these moves. There's another one, ULTY, that's generating the same kind of buzz. And if you want to see exactly what happens when you invest in that fund, with the same breakdown of $1,000, $10,000, and $100,000, click the video on your screen right now. Because once you see MSTY and ULTY side by side, you'll know exactly which income strategy fits your portfolio.